I keep hearing the same thing from very successful and smart investors. I'm more anxious about the economy than I've ever been. Tariffs, trade tensions, deficits, interest rates, volatility, there is a lot. But the thing that really stood out for me recently is not the anxiety itself, it's what people do because of it, the mistakes they make. In this video, I'm gonna walk you through 5 fundamental mistakes that investors make when fear takes over. Mistakes that can cost you hundreds of thousands, if not millions of dollars over a lifetime. This isn't about the latest hot stock tips or crypto tips. It's all about avoiding the decisions that can blow up decades of discipline. We'll go mistake by mistake and I'll tell you exactly what to do instead. Mistake number 1, keeping too much capital on the sidelines. The first mistake is sitting on cash because it feels safe. And I get it. When you get cash, you feel like you're in control. You feel the certainty. But long term, it can quietly become one of the most expensive choices you'll ever make. Here is why this matters. Even a decent cash yield of 2, 3, 4% a year does not match what real life demands. Your retirement, your education, your financial freedom requires growth. And if you take the taxes, when you take the inflation, you're basically trading water. You are not building wealth. I've seen people with real discipline really sabotage themselves here. They think they're conservative, they put the cash aside, but what really happens is the opportunity cost of what this money could have made for them, the growth in the market when they invested long term. Let's use a simple math. If you use cash derivative for $100,000 and 4% a year over 30 years, you'll get $324,000. But the same $100,000 at 10% a year will yield you in 30 years $1.7 million. That's not a small difference. That's a huge flexibility and choices down the road. So what to do instead? Keep an emergency fund of 6 to 12% of your living expenses. That is your safety net. That is your insurance policy. Anything beyond that, you need to create a plan, a consistent plan of investing in the market and contribute to your plan regularly, consistently. That's what beats the timing in the market. Mistake number 2 is investors treat the 60% stocks, 40% bond as true diversification. That might have been true in certain decades of investing lifespan when stocks and bonds that did move differently, but now with inflation-driven regimes, both stocks and bonds can simultaneously fall together and doesn't provide you the same level of protection that 20, 30 years ago they might have provided. Why this matters? If your diversification is sitting on 2 asset classes that can sync together at the same time, you're not really diversified. You're concentrated on one big macro outcome. Here's a practical example. When inflation rises and interest rate rises as well, then bonds get hit and equity markets and stock can also get hit as well at the same time. So what to do instead? Diversified intentionally. Public stocks and bonds can still be your core building blocks of a portfolio, but you need to add some diversifiers as well. For example, consider real assets, infrastructure, real estate, private credit. They can add to your portfolio without being contingent to the same daily public market moves. You can have, for example, a global, thoughtful allocation. You can have REITs, what's called real estate trust. You can have publicly listed, diversified infrastructure funds, and you can have the commodity market. The goal is not about perfection. It's about avoiding the everything collapses at the same time kind of risk. Mistake number 3, concluding that markets don't work and it's all a rigged game. So what people do? They opt out, they stop investing, or they become so defensive that they are not contributing anything meaningful because they feel like there's opportunities for the wealthy people. They get early access to something. There's these institutions, they get access to this company stocks way before the public market get a chance to participate. So they say, oh, this is all rigged and better stay away. And they lose out on the biggest opportunity of their lifetime to become wealthy and financially free, because it's easier than ever right now to invest. All you need to have is a phone, a brokerage account. You can start with even $10 and own a share of the economy. So this is incredible, but some people still have this mindset that because there's unequal opportunities, I'll better stay out of the game. Completely wrong mindset. So what to do instead? Stay informed, stay investment, become financially literate, diversify your portfolio, and have the long-term mindset, consistently invest in public companies, in the equities, in the growth of the economic engine, and contribute in consistent times. Mistake number 4 is ignoring the risk to dollar dominance. Assuming the dollar is going to continue to be the world's leading currency for decades and decades to come is something of a big bet. And if you have zero hedge, you're betting even without you realizing it. You see, for decades, dollar was dominant, but it can no longer be the case because empires tend to go down. And what's happening right now with $38 trillion or so of national US debt, that can really devalue even more the currency. So you need to have an edge. For example, a strategic 2 to 5% allocation to Bitcoin can be a hedge against the devaluation of the dollar. Also, you want to diversify universally around the world, not just in one currency, not just in one region, but in different countries, in different currencies, so you have enough hedge, enough protection. That is the idea. Mistake number 5 is waiting for certainty before you start investing. This might be the most common ones. People are waiting for certainty, for the perfect moment, for the perfect headline, which never comes. And here is the reality. Investing and markets are always gonna be surrounded with uncertainty. And even more important is during the times of the most uncertainty, this is where the most opportunity lies because the markets crash, the prices crash, there's a lot of uncertainty, and this is the exact time where you should be investing. It's actually a very common pattern. People sit on the sidelines, everything crashes, then the markets recover, they finally feel safe, and then when they start investing and they missed the greatest opportunities of their life to buy assets cheap. So what to do instead? Stop trying to feel certain. Dollar cost average, regardless of the market, regardless of the time, regardless if it's low or if it's high, just keep buying assets consistently. That's what works, because investing is actually a long-term game. Think about 10 years plus. So it doesn't really matter. You need to be in the game, stay invested, and have a strategy. So that's it for today's video. If you want a simple plan that you can actually follow, download my free guide, 5 simple steps to turn your income into lasting wealth and passive cash flow. It's designed to help you build a real plan of saving, investing, and compounding without the hype, without the gambling. And remember this, uncertainty is normal. Wealth is built by staying disciplined when certainty is actually impossible to achieve.